With markets still navigating uncertainty and volatility, smart investors know that the best opportunities often come when quality companies go temporarily out of favor. In this month's breakdown, we'll look at 3 standout stocks that present compelling long-term potential, each one with a different risk profile. From a dominant tech giant to a high-yielding pharma leader to a global lithium powerhouse, these are the stocks worth keeping on your radar right now. Amazon ticker symbol AMZN. Starting with the lowest risk pick on the list, Amazon, ticker symbol AMZN. After dropping more than 25% in just the past 3 months, the stock is starting to look like a textbook buy-the-dip opportunity. Amazon continues to generate over $600 billion in annual revenue, an astonishing number, and still maintains double-digit growth, which is extremely rare at that scale. Even more impressive is that while the company pours billions back into growth initiatives, it still managed to post nearly $60 billion in net income last year. Some may criticize its margins, but this overlooks the bigger picture. Amazon is playing the long game, reinvesting profits to secure dominance across multiple sectors. The strength of Amazon's core businesses cannot be overstated. In the US, its e-commerce ecosystem is so strong that it often beats local retail stores on both price and speed. Add in its cloud computing division, AWS, and a rapidly growing digital advertising segment, both of which are significantly more profitable than retail, and Amazon is building a high-margin engine beneath its surface-level numbers. On top of that, it's making major moves into artificial intelligence, electric vehicles, autonomous driving, streaming, and gaming. Finally, when looking at valuation, the stock now trades at a price-to-earnings ratio 84% lower than its 5-year average, with a PEG ratio in line with sector medians. That combination of scale, innovation, and now attractive pricing makes it a standout long-term opportunity. Merck ticker symbol MRK. Next on the list is Merck, ticker symbol MRK, a pharmaceutical heavyweight that's been largely overlooked after a significant drop in its share price. The stock has declined more than 38% over the past year and is now down over 40% from its all-time highs. Despite this, Merck remains one of the most established players in the industry, known for its strong pipeline, steady growth, and attractive dividend. In fact, the dividend yield has now climbed to over 4%, the highest level seen in more than a decade. Much of the recent fear around Merck is tied to the expected patent expiration of its blockbuster cancer drug, Keytruda, in 2028. However, the company is already taking strategic steps to offset that risk. These include developing a subcutaneous version of Keytruda that could extend its patent life, gaining regulatory approval for new drugs like one for pulmonary arterial hypertension, and entering promising partnerships in weight loss treatments and cancer therapies. Merck also maintains strong operations across infectious disease, vaccines, and animal health, segments that provide both diversification and growth potential. With a valuation now more than 50% below the sector average on a PE and PEG basis, Merck offers a compelling mix of value, yield, and long-term upside, especially for investors seeking stable returns. Albemarle, ticker symbol ALB. For those willing to take on more risk in exchange for potentially higher rewards, Albemarle, ticker symbol ALB, could be worth a closer look. As the world's largest lithium producer, Albemarle plays a critical role in the global transition to electric vehicles and renewable energy. Yet, despite its importance, the stock has crashed over 35% this year and more than 80% from its peak. This steep decline is mainly due to 2 factors: weakening lithium prices and rising global trade tensions, particularly tariffs. Lithium prices have dropped sharply, and Albemarle's stock has followed suit almost in lockstep. However, the long-term demand story for lithium remains extremely strong. According to analysts at McKinsey, global demand for lithium is expected to nearly quadruple by 2030. With EVs, energy storage systems, and consumer electronics all dependent on lithium, a rebound in prices over time could provide a strong tailwind for Albemarle. Beyond lithium, the company is also diversified with high-margin businesses like bromine, used in flame retardants and water treatment, and a catalyst division that supports oil refining in emerging markets. These segments help stabilize the business and generate steady cash flow. Even more encouraging, Albemarle has paid and grown its dividend for over 30 consecutive years, weathering multiple cycles along the way. While the current yield sits just under 3%, further downside in the stock would only make that yield more attractive for long-term income investors. Those are three standout stocks to consider this month, each with a different balance of risk and reward. Whether you're focused on growth, income, or long-term transformation plays, there's something on this list for every kind of investor. As always, make sure to do your own due diligence before buying, and feel free to share in the comments what stocks you're watching or buying this month. Thanks for tuning in, and I'll catch you in the next one.